Holy moly.
So I am 25% of the underlying stock clear on that income machine play right now. So it's great when you get some of these big dogs rolling. They can cover a lot of ground. We did some NVIDIA plays when it was ripping, kind of same thing. We were up 10, 12, 15% clear on those spreads, which is, another reason I really like trading that way. And then you still have some Apple action, right,
Yeah,
Graham?
that was my next thing I was going to say. I don't want to speak too early because I tend to jinx these things. But Apple's looking good today. We've got a perfect income trade on it and perfect Apple trade. So far, so good. Again, don't want to jinx anything.
Well, a little while ago, I walked people through the monthly chart on Apple, which I know no one likes to look at a monthly chart.
Mm-hmm.
I think I was getting some yawns as I was going through it. But on the monthly chart, Apple typically, after one red month, will have several positive months. And you look at that, it's pretty consistent over the course of several years. And we got that kind of red drop month and then a continuation with a green month last month, showing, listen, if you go red, green, usually you're going to get some fall through. As simple as that. Frankly, if all you do is trade Apple after it goes red, green on a monthly chart with a buy and hold trade, you will do extremely, extremely well on Apple. And that's what we got right now. So I think that we're going to get some decent fall through on Apple. I'm still holding a couple pieces there. And I know that you have that one that is up nicely right now, going for another 100%er there. So yeah, lots of good things rolling across the board. Mike said, take profits. Mike, right now, so just to give you guys my setup on AMD right now, I took some shares. I took 1,000 shares right at the earnings drop. So I got in within, I think, 50 cents of the lows. Just straight up lucky. Not by no means did I put together a perfect strategy there. I just liked the stock. It had good earnings. It dropped anyway. And I ended up just by luck getting in right at the bottom with 1,000 shares. And so what I immediately did is I set a target for a good chunk of those shares. Let's see what I did. I'll give you the exact numbers here. For 199.75 is what I set my target for, with the idea that I'm not going to chase it all the way to all-time highs, but I think it has the chance to rip to all-time highs. And even if I get within striking distance, I'll jump out. That'll be like a 30% ROI or something on 1,000 shares, which, for that level, I'd happily take and run with. But now it's moved so darn quick that I'm very tempted to take a portion of those shares off, already being up, right now 16.3%, which is just insane in that short of time. So I got to make a decision if I'm going to adjust my trade management here or stick to my initial guns and go for the full bang at 199.75, which is where my current target is there.
Yeah, it looks really good. What is that, 52-week highs today? Oh, yeah, we actually have a fun fact for you guys. We do have an Apex entry on AMD right now as well.
And the all-time high, I just looked at it, was 227. So, we're still talking about just to get kind of that catch-up trade that we talked about. And see, the other thing I like about AMD, the reason I keep looking at it and convincing myself to hold on it, we had this incredibly steep run-up since April. Don't get me wrong. It is wildly steep. Any indicator you pull it up, RSI, anything else is going to be overloaded. But we had that little flush there. And so it looks like maybe it just got a little gas in the tank, and we could see some fall through, and it could make that run up to 200 without even really taking another breather. So I keep convincing myself that maybe I should just hold on and let something that's ripping keep ripping until it changes its mind. So like I said, I'll keep you guys in the loop if I do anything differently, but just loving the pure momentum plays right now with AMD, with Tesla now showing momentum after that breakout, Bitcoin, and a couple others. So all that being said, that's kind of the slate that Graham and I have open that we're looking at right now. We've been talking a ton about seasonals. Graham's a big seasonal guy. What's going on right now? August has its tendencies to be a weaker performing month than September, the weakest for many of the sectors. And a couple months ago, we were talking about seasonals with a gentleman named Silas, who we actually are bringing on the show today. And Graham, you can give me your take here. But I would say that within about 2 minutes of Silas walking us through what he's seeing, we thought, wow, this is the best seasonal analysis we've ever seen.
Yeah, and the tools he's created are bar none the best that I've ever seen. And I've used a lot of different tools through the years, and very expensive ones too. So I'm excited to see it.
So we thought, wow, we need to get Silas connected. I mean, he's very in line with what we're doing. He has a little bit more of like a futures focused background and things like that, but still trade stocks and options. And so we thought we need to get him on some opening playbooks on some other sessions, and maybe even, start working with him on a full-time basis to get these tools kind of within our ecosystem. But for now, we thought, let's just get him on to an opening playbook session, kind of let him walk you through how he approaches the market. Let him walk you through what he's seeing, using those tools and things like that. Cause I think you guys will be pretty blown away by the level of analysis. So I think Silas is in the waiting room now. Let's see if we can grab him on there. There we go. All right. So Silas, I think that you are now officially in the room. If you unmute and let us know if you can hear us.
Hello. Check.
All right. You're in. Hello.
Good morning.
First of all, thanks for being on opening playbook, kind of a last minute guest appearance. We knew that we wanted to talk a little bit about seasonals as we get in the middle of August here, where things start to change a little bit with, I won't go into all the weeds. I'll let you do that. But Graham normally will take us through the sectors and specific stocks. We thought, let's just, instead of doing it with kind of our hodgepodge of data that we like to look at, let's get the king of seasonals on the show today and walk them through this. So if you want to jump on in, I think you mentioned you have a couple kind of top-down things to cover, and then we'll jump into the tools. But if you guys have questions, comments, throw those in the chat. Me and Graham will kind of cycle those through to Silas in real time. But I think you guys are going to love some of the analysis here, because it's a lot deeper and more sophisticated than probably what you'll get from us on a typical presentation with some bullet points. So Silas, take it away, man.
All right. Well, thanks so mumuch for having me on the show. This is my first time here. I really appreciate it. And the sound is good. I guess you guys can see my mug, unfortunately, but I appreciate you guys having me on. Graham and Nathan, great intro there. Whoever put the intro music together too, that was pretty slick.
That was AI, actually. I can't take credit. I told people originally that I recorded that in my basement, playing all the instruments separately. But actually, I have not a musical gene in my body, and that was all AI.
Well, very good stuff. But yeah, I'm gonna look. We'll cut right to the chase. I know the markets are on the move. We got a lot to look at today. Graham and Nate are going to have some more fresh ideas for you. But yeah, like Nathan said, I'm just kind of here to give you my insight, my take on seasonality. That's my background going back, gosh, I guess 15, 20 years now. That's where it all started. And the fact that I'm still using it today, I think speaks volumes that, I don't talk about seasonality just to listen to myself. I believe in seasonality, but it's important to know that seasonality, just like everything else, is a tool, right? We use it as a tool for confluence into any other analysis pieces that we may be incorporating, whether it's fundamental, whether it's technical, whatever it is you may be looking at. It's just simply a tool. And we use that to put odds in our favor. We call it odds enhancers. And that's essentially what we're doing. So what I'm going to do, I have permission to share my deck here.
Yeah, you should be able to pull it up, and then Dave can add it in kind of into the screen there for everyone to see.
Right. So yeah, what I'll do is I just put together, can you guys see the slides there?
Yep.
Okay. So yeah, what I want to do is just do a quick overview here. Not a lot of fluffery, just kind of hitting right straight to the facts. And we are now in the middle of August. And, again, I think seasonal investing and seasonal trading can be a good risk mitigation strategy. Of course, if enacted properly, you don't abuse it. We know historical tendencies provide an indication of how people act and react at different points in the year. And, we like to say history does like to repeat itself. And we will have years where markets will tend to kind of go off the reservation, if you will. But history does tend to repeat itself. And again, those are some of the odd enhancers that we like to put in our back pocket. So we know where we are right now during the final 2 months of the third quarter, knowing the historical precedent of the market is pretty important given some of the erratic trading environment that can lead to some volatility and unexpected results. So this is the most volatile time of the year, and it's important to have a game plan. And the game plan that we're kind of approaching here is we look top down at various markets through various time frames. And VIX is one of those that we looked at, whether you trade VIX or just use it as an instrument to kind of guide some of your trading decisions. Knowing some statistics here about VIX and how it relates to equity markets as well as markets in general can be helpful. So knowing that the VIX has averaged about a jump of about 9.3% in August alone, with 60% of those periods over the last 20 years, it holds weight. It holds weight, and people refer to VIX as fear gauge. There's several different instruments on how that you could physically play this, but why do we see a jump in the VIX or volatility index? So a lot of these catalysts are lower volumes, lack of general overall catalysts, just kind of quietness, the larger institutional traders and volume stepping away. Those are some of the factors behind what is usually a weaker period for risk assets. Now, if this historical context that requires a little bit of a degree of short-term pessimism in being long, being bullish. Now we're not, we are not fear mongers here. We're not perma bears. We're not saying stuff your cash, in your mattress, but it is just being cognizant and aware of where we are in terms of the calendar year through the lens of seasonality, as where we are in current prices. Okay. Especially considering the move we've made from the liberation lows. And so it's just a time to be prudent and aware, not, having FOMO, not chasing, what we call nosebleed highs, being patient and looking for those opportunities. And so this is how we approach kind of this remaining last bit of summer period, and we wait for those opportunities to come to us rather than really speculating and having that FOMO creep in. Now, I think this is a good chart here. I don't know if I have a drawing tool. I'm kind of scared to mess with it, but if we look right here, you can see my mouse there in August. These are some stats here that I think are pretty important. You can see that following the summer rally period in July, which, by the way, a lot of folks think July is a very volatile or weak period of the year. There's actually a very good seasonal window there in July, but that does lead to a spike in the VIX, strengthened bond prices, at least relative to stocks, as traders, investors are kind of searching for those safe havens to sit out the storm. So you can see that over 20 years, the VIX has averaged a gain of 9.3%. Obviously, if we see a rise in VIX, that's going to be inverse to a rise or gains in the equity market. So the S&P averaged a gain of a mere about 40 basis points, and that's over the last 50 years. That's half a century. So that is why we really hone in on those numbers. Now, again, these numbers, particularly during periods of economic struggles, given that positive catalysts during a slower period are typically fewer. So these kind of numbers do lead to equity market volatility ramping up. Really, that could be between last part of July and the start of October, which has a great influence into increases in VIX. Now, I'll give you a little strategy here if you want to take some notes. And what we'll do, I think, is maybe jump into the charts here. So a strategy that we like to look at, or we can consider this work very well for us, is when we start to see signs of complacency emerge and the volatility as gauged to the VIX is low, printing around the 11 to 12 mark, purchasing investments tied to the VIX can serve as an effective hedge against abrupt downturns in the equity market. And so I could one of the, I think the most widely VIX ETN is VXX. But if we flip to the charts here, hopefully you guys can see the charts. What we'll do is go to the VIX here. This is just a daily chart. And so kind of a simple way here of determining, and this is not a standalone strategy, it's just a guideline, but a simple way of determining when to be buyers and sellers of stocks is sell stocks when the VIX bottoms below 12 and buy when the VIX peaks above 21. And again, those are hard figures. It's just a guideline. And we can see, the last time the VIX bottomed down here below 12 was in July of last year. And then the VIX has been kind of elevating ever since. And then the following peak above 21 realized in August of that year, providing a brief but kind of ideal entry exit trade, if you will. And then we saw buy signals coming in this past April when the volatility surged and peaked surrounding the trade policy, the tariff policies, and probably unlikely we'll observe another sell signal, where i.e. VIX below 12 before the third quarter volatility sets in. But again, it's just kind of exercising some prudence there, being conservative in stocks, in your allocation to the long side beyond this summer rally time frame, and what could lead to maybe another volatility shock. That volatility shock could be another washout of current sentiment, and therefore presents opportunity. So we like to say, volatility will often have people scrambling to the sidelines, and they're often exiting and or entering at really the worst possible times of the market. So if you know how to kind of view this, playing seasonality, technicals, fundamentals, kind of our three-pronged approach to all of this, to really any market, whether it's a stock, commodity, a currency, or the VIX or the S&P. But we say volatility does equal opportunity, okay? And so that's kind of like, we sell in complacency, buying fear, regardless of, quote unquote, precise dates on a calendar. And so if we come back to the charts, I'll cover a few key markets before I turn it back over to the guys. But gold, so when we talk about fear rising, precious metals can act as a hedge against volatility. You can see here, these are some snapshots. We'll actually dive into the software, but I think that this is important if you guys want to take some pictures of this to have an idea. We're working with data, and that's really all it is. So we're taking this data. We understand what's happening over 10, 20, and then a life of contract period of data that we actually have. And we see that gold and precious metals can and often do serve as a benefit from erratic trading that we often see. Now, we had a couple nodes of volatility over the past few weeks, but other than that, it's been a pretty steady stream higher. Now, gold, just for your reference, has gained about just shy of under 3%, 2.9% on average during this period of the last 25 years, while stocks, as gauged by the Gold Bug Index, has average gain of 1.2%. So volatility is just one benefit to the price of gold over this time frame. And people generally like to buy gold. They like to own gold, whether that's physical or through something like GLD or gold futures. And so we typically prefer to be buyers of gold when that time and technicals and everything, all the so-called stars align. And so right now, if we go back and look at, we'll look at gold, and we can look at gold futures. We can also look at GLD. We're going to see the same picture here, but gold's been stuck at a range, right? Gold's been stuck at this range here. Obvious trend is higher lows, higher highs, technical analysis 101. And what we're looking for is, I think the path of least resistance here is got to be a breakout to the upside. Gold is not a market that I'll sell gold. I'll sell gold from a speculative basis, but this is not a market that I want to try and short, considering the volatile or seasonal headwinds that we could be facing. And we can look at some more of that data in a second. Another market worth warranting that I am long and participating in through through various options plays or through the fixed income market, doing this through 30-year bonds. We are, again, about nearing the halfway point of August, but August kicks off the optimal holding period for fixed income. And this also can present a hedge against equity market volatility. So again, my job here is not to instill fear saying that we're going to have unprecedented amounts of volatility heading our way. My job is to present you stats and data, and then we can dial that in looking through technical analysis to time entry points. And so this is where we started getting long 30-year bond. If we were not getting long, this data should alone be telling you that we damn sure don't want to be short, right? We don't want to be short. Why would you want to be short when you've got data, 10, 20, 30 plus years of data telling you that the right side of the chart, the part of the chart that every trader investor wants to know, the right-hand side, well, we have that roadmap. We know what we're looking for are these very definitive turning points, these cycle turning points in any market, whether it's a stock, whether it's Bitcoin, whether it's Canadian dollar or 30-year bonds in this example. This is where we are trying to line up entry points because we can clearly see a confluence of averages that bottom out, find a cycle trough or calendar low here, and then they trade higher. So if you're looking at this chart and you and I are seeing the same thing, well, if we're long fixed income, whether that's through the aggregate bond ETF, AGG, whether that's through 30 years, 10-year notes, any fixed income asset, when do we want it? When would we look to start peeling those positions off at a minimum, tightening stops and de-risking right around in here? Because we can clearly see, thankfully, using historical data, that this is a market that tends to top out or find a cycle high into around late November. I think that is something that we could all agree on. If you showed my 11-year-old daughter who has no interest in trading or investing, she could say, well, this looks like a high and this looks like a low. That's where we're using the data, okay? And those that may not be trading the 30-year or 10-year note, it's very, we can go into basically any bond ETF. We can look at TLT, AGG, for instance. Let's actually look at TLT. It's going to closely more mirror the 30-year. And, we just look at these simple patterns here. And right now we've got bonds kind of trying, at least appearing to forge a bottom here. Well, we know the path of least resistance based off 10 and 20 years of averages point higher. So depending on, if you buy on pullbacks or you buy on breakouts, you have that information there regardless of what your style is. We wait for the breakout, maybe a retest and then higher. We wait for a pullback into some of our institutional demand zones. There's many ways to do that. Now, another couple of markets here before I finish, and you guys can stop me or interrupt me if I'm getting too long-winded. But these are the markets that I dial into, that I'm on top of, not just at the first of the month, but really, every day, every week. I'm asking, okay, I'm starting with the S&P 500. Then we can dial into, say, the Dow, Russell, NASDAQ, if you're trading those, where the 30-year bond or the bond market in general, gold, US dollar, oil, and then we kind of start there with top down. And then we can then use some of that data, some of those clues to get into individual equity names, individual ETFs, and so on. So the dollar index, another very important metric that we look at, some other cues that could possibly signal a shift of market mentality that coincides with a period of volatility for stocks. So is how is the dollar reacting? How is the VIX reacting? And so here are the seasonal, not expectations. This is just, this is raw historical data that none of us have made up. This is what has actually happened. And so here we are, in mid-August, looking into the back half of August, we can clearly see that prices historically rise. And what we're looking for here is, we call it kind of price and time. We want to see price and time align, price and time to match. So what that means is, if we are expecting seasonal lows right around in this time frame, we want to see price down in this area too. We don't really want to see price way up here in our seasonals down here, or seasonals here and price down here. We want price and time to align. So if we go back and look at the dollar index, we have just that, right? We have prices down here kind of hovering at these lows, prices where we're at an area where prices have reacted in the past, right, through technical analysis. And we can see that this is also where seasonals align, or seasonals bottom, okay? And so if we start to see a rise in the dollar, typically that could be a headwind for stocks. Typically, they move inversely to each other. It's not always the case. Okay, now let's get into the big one, the big daddy. S&P 500. This is the global benchmark. And August expectations, doesn't seem like that today over the last few sessions, but August is a rather flat month for the S&P. Over the past 5 decades, it's 50 years, the S&P has gained just 20 basis points, 0.2%. And that's the third weakest return on the calendar year, which lags September's 0.9% average and February's, 0.9 average drawdown, not gain in September, and February's 0.1% or 1 basis point gain. Okay. Now, looking here, when I put this together yesterday, you can see in green, that is this year's performance, okay? And then we have the data going back 10, 20, 30 years. And so we can all see, again, you ask your daughter or your son or your grandchild, we can see, well, it looks like we head lower from here. And again, we're just using this as a data point here for confluence. Now, what's interesting about this year is, for post-election year, we talk about the election cycle. For post-election years under a new presidential party, the summer rally timeframes do often stretch into August before the period of weakness for stocks kind of take way in later August and into September, especially into October. And so this year's summer rally that we saw since late June has caused the year-to-date performance of the S&P to kind of drift off the average trend, at least during equivalent years in the presidential election cycle. But if the incumbent party, it actually does place it more in line with how the market performs on average than if the incumbent party remained in place following last year's election. So sorry if that was confusing. So in short, market performance during the initial phase of the new president's leadership is not normally anything exceptional. Why? Because investors are digesting new policies, some of the uncertainty that follows, and no doubt that we have some uncertainty that follows with this administration. Look, politics aside, the markets we're largely trading off headlines, and I don't see that really changing anytime soon. There's still a reasonable likelihood that this uncertainty will prevail again heading into the late summer period. And if we do get that opportunity, that will result in renewed buying opportunities for the strength that has been commonplace through the last 3 months of the year. So yes, we may have taken brief detours, or what I like to call kind of going off the reservation during different points of the year, because that's what we have to expect. That's realistic that, sometimes markets will go this when they're supposed to go this. It's about encompassing the basket of averages here and trying to line up price and time with that. And so if that is the case, there's a decent argument that by year end, we may see some of the lackluster performance that post-presidential years are known for, and that'd be in the terms of actual performance numbers. So if we look at the raw data here, right in the middle, it's the third weakest, right? Positive August still outnumber negative ones with a gain frequency of about 56% of the time. Okay. Now, what's interesting is the range here the range between the max gain and the max loss is the second largest spread of the year, falling only behind October, a month that is notorious for volatility. And so August is typically a month that traders and investors have digested second quarter earnings. That kind of fuels some of the volatility through the month of September. Generally lower trading volumes as the larger institutional players are taking vacations. Just a general lack of fundamental catalyst in the late summer can kind of lead to that volatility and keep investors on their toes. Okay. And so this is probably where I'll wrap it up. What I will do quickly is just give you a few more data points, and then I'll turn it back over to the guys. So if we look over at the S&P, we are, and I always go to the futures market. So if you guys want me to, we can look at SPX, we can look at SPY, we can look at any market you guys want. But obviously here, when you're at new all-time highs, we can't sell. We have no reference points to sell against. So if you're just classic technical analysis, trend trading 101, you're going to trade with the trend. Okay. Now, I'm not interested in buying new all-time highs, but I will be looking for retracements, retracements back to important areas of, you call it support, demand, whatever you want to call it. And what I have found in my trading is doing a higher time frame analysis and then going down to a lower time frame for entry and execution. We can get a little bit more sniper-like. And really, there's no magic multi-time frame mix. It's really kind of dependent on your style and your objectives and how active you want to be. But starting with the higher time frame, using monthly, weekly, daily data points, and then going down into those lower time frames if you can. Might be 4 hour, might be a 1 hour, might be a 10-minute. And if you're day trading, it could be a 1 or 2 minute. And one last data point here that we will see, or we should look at, is let's go to the software. And these are, you saw this on the charts, and if you guys have questions, let me know. But this is again what we're looking at on the SPY. So what we can see this is where we are in green, 2025, and we can hide this. And we like to look at D-trend and seasonality, and D-trend and seasonality compared to classic seasonality. What that does is it uses a linear regression calculation to smooth out the data and gives us more defined turning points. Okay, so this is what I'm talking about when we're trying to align price and time. So if we turn back 2025 back on, can we agree that price and time are in line? I would say yes. Here we are in price. Here we are in time. So if we know that we're up here and we know the averages or the right side of the chart point down, then that to me, that expresses I should be a little cautionary on implementing new longs, okay? Or at least maybe tightening risk, managing, long exposure profits that you probably have if you're long.
Well, Silas,
get more data, going down here, percent of positive months. If the histograms, look, you don't have to be a mathematician here. If the histograms are heading lower, percent of positive months, we can see August and September are two of the weakest months of the calendar year, aside from June. Average monthly performance, if I see histograms south of 0%, then it's telling me that I probably do not want to be aggressively long and maybe not be long at all. I should maybe be looking at cash, and or if I'm skilled enough, I should be looking at taking short positions, buying put, selling bear call spreads, whatever your flavor or style may be. Okay. And so average volatility, the way we kind of use this table, we can use this for individual stocks or commodities as well. The way I use this is really on how I'm going to play options. Okay. So if I know that average volatility is higher, I might be more apt to selling premium, selling better call spreads, selling bull put spreads, whatever directional bias I have. On periods of lower volatility, that means premium options should be on the cheaper end, and would rather be a debit buyer, either outright call, outright put, or outright spread. Okay, just kind of showing you again some of the markets that we are in and we are looking at here. Looking at the 30-year bond, our algo rank is giving us a buy. We know that seasonality is pointing up and to the right. Therefore, we should have a long bias. Okay. But as we get into maybe late August, early September, we might want to start taking some of that long exposure off and then looking for ideas to short. Percent of positive months, we start to see a decline here in the histogram. If percent of positive months is decreasing, we probably don't want to be heavy long exposure. Same thing here. Monthly average performance, September and October are south of 0%. I don't think we want to be long, right? And that's just trading with the odds. A couple other markets here. We talked about gold. We look at gold. Here is where we are in terms of price in the green here. Here are averages going back to 1970. I mean, that's 50 years of data. 50 years of data. I don't want to trade against those seasonal headwinds. And so we would be favoring short ideas until we get into around mid-December. Again, if we're expecting volatility, you're expecting the world to end. I'm not saying you are, but if you're one of those, you probably don't want to be short gold anyway. So shorting gold can be a little tricky. And then let's look at one more here. We didn't talk about that in the slides, but crude oil here. Let's turn it back on. Here we are in crude. We're kind of following its seasonal norms right now, and we'll be looking for a short-term bottom here more towards the back half of August, heading into early September before we find a peak into mid-October. And then one last thing, if we look at the COT or commitment of traders data, I think this is just worth noting. It's worth interest. And so what we do, our table tracks the last 4 weeks of data, and you can see that non-commercial hedge funds, this is the data that we're looking at, non-commercial hedge funds. That's the smart money that we want to track and follow. The data's been a bit mixed, right? As we've been approaching all-time highs, you can see that pretty decent shorts here, 150,000, 159,000 net short. Last week, we saw a net change of around 37,000 contracts. This tilts into the bullish camp. How? Because we saw 17,000 contracts added to the long side. Simultaneously, we saw 19,800 contracts liquidated from the short side. So if you're adding longs, that's bullish. If you're liquidating shorts or short covering, that's bullish. You add those two together, that gets you your net change of 37,000 contracts. And it's coming at a time when we're seeing all-time highs. But again, the data is mixed. If you look at the Dow Jones, we will look at the data, but not too much because it's the volume's a lot lower here. But you can see that the short interest is picking up steam. We've gone from 3,500 contracts net long to 600 contracts net long to 2,900 contracts net short to 3,900 contracts net short. Well, that net position has gone from bullish to neutral to bearish. And then if we look at the NASDAQ, small change here, just about a 2,200 contract decrease from last week. And then the Russell here continues to ramp up. The shorts continue to ramp up here. For the last 3 weeks, we've been increasing that net short position by approximately 8,000 to 10,000 contracts. Okay. So just again, data points worth noting. We're looking at seasonality. We're looking at technicals, and we're looking at how smart money is positioning. That's kind of really where the three-prong approach is in our system. So I'll shut up for now and turn it back over. I hope that you guys got a little bit of insight or value from this, and I do appreciate the opportunity to come on and share these thoughts.
It was awesome. Can you hear me, Silas?
Yeah.
Yeah, I thought it was awesome. So much data. I mean, we could have spent 4 hours just kind of diving into some of the data that is there. I mean, hopefully you guys are getting just a little bit of a grasp. We'll have Silas on more, but hopefully you're getting just a little grasp of how much data Silas has put the work into putting. I mean, he flipped through just a couple of his tools there. You can dive into seasonality. You can dive into seasonality by instrument. You can dive into averaged out and different time frames with and without certain dates. I mean, it's just incredible how much is in there. But the one thing I kind of took away that I thought was interesting, actually maybe two things. One, you mentioned you can't really short the S&P with no frame of reference to short it from, which is actually what I kind of said yesterday. I kind of have to be long until the market stops being bullish and until it actually does something. But I like the idea that maybe you stay bullish. At least, I kind of use more defensive trades in these all-time high environments where I'm setting up spreads below the current price and I have a little bit of room for a pullback. But maybe you start building a position in the VIX as kind of a way to, maybe you're still long, you're still holding your positions, but you put out a debit spread or a credit spread on the VIX to the upside for 8 weeks from now. And if it grinds down to 11, you double down. And if it, and you actually do kind of build a traditional position waiting for that volatility spike that doesn't start putting you on the other side where you're now burning puts and hedging aggressively, because that's really tough. But you just build a position on the VIX at the same time. That was kind of one of the takeaways that entered my mind. I'm curious your thoughts on that. And the other thing you mentioned, which I've actually been thinking about now for about 2 months, that I'm considering putting on, which is a significant position, IWM short, SPY long, with the idea that if we get the continued melt up and I put a position that pays like 150 to 200% on a long debit spread, and then 150 to 200% on a short debit spread on the IWM, if the market squeezes up, I'll make my money on the SPY. If it flushes down, I'll make my money on the IWM short. And if it's anywhere in between, I'll just manage the position and kind of use it as a break-even hedge. So those were kind of the two things that I got. Curious your thoughts on those.
Yeah, no, I love the VIX play, and that's something that what I like to phrase is legging in to expressing an opinion, because trying to short all-time highs, I found and experienced is kind of a mug's game. You're just kind of, well, it's too high, it's got to correct. Well, right. That's BS. Anything you keep going higher, anything you keep going lower, you've got to wait for the market to kind of confirm that thesis. Now, we do have these data points that say, hey, caution is warranted. Doesn't mean that we can't keep screaming higher. And then now you've got tariff headlines coming in, you don't know how the market's going to react. That can blow seasonal data points out of the water. So, stick with the high odd trade, and that's just trading with the trend, buying pullbacks, but expressing an interest, in what could come. I like the thoughts there, instead of just trying to sell the S&P and getting a face peel because it's going to go higher. Well, we could start expressing that opinion through VIX, like you said. Maybe start adding, providing some small debit spreads, maybe selling out of the money puts, on those instruments. If you're okay getting assigned, that's the way I look at it. I mean, you can sell and manage your risk and not take assignment, but for those possibly with larger accounts, hey, I'm okay taking this, building a longer term positioning, maybe doing some averaging. But yeah, I like the trade, and I kind of like the pairs trade you mentioned. So with your SPY Russell, are you using leveraged ETFs or just standard?
What I typically do is I trade the IWM and then the XSP, and so I'll do the IWM a bear put debit spread. So I like the debit spreads versus the credit spreads traditionally if I'm doing directional, even if I'm not usually. But that way I can go maybe 2% out of the money to the downside on the IWM and still get 120, 130% ROI potential. Do the same thing on the upside, so that if one hits and the other misses, I'm still net ahead on the position. But if they diverge, which I actually think there is a chance that they'll diverge with I think IWM's kind of trying to catch up right now. I could very easily see that stalling out and moving to the downside, just because I think right now it's a lot of hope on rate cuts and things like that. I don't think the profitability, if you look at the earnings and things, are anywhere near where they should be for the IWM to actually have a catch-up trade against the SPY and the big dogs where it's weighted. But you know what we could do, and we can let the chat maybe give us some direction here, Silas. What we could do is have you back on, next week or a little bit after, and do kind of a whole session on that pair trade. We could look at your seasonality numbers. We could look at your commitment to traders numbers. We could look at all your tools and basically frame out how would you set up this pair trade? What dates would you use? What expectations? How far out of the money? And just literally do an entire session around building that trade. And at the end of the session, I can put my trade on, whether I go 10 grand on each side or whatever. That could be kind of the culmination of a session. So I don't know, in the chat, you can let us know if you think that would be a cool session to really like do a deep dive on one trade, build all the analysis around it, mark it up, put the plan together. Then I could trade it live in front of everyone and you guys could copy it. We could have Silas back on and do like a deep dive on that if you guys think that would be cool. Or Silas, if you're open to it, I should probably ask your permission to use your tools and commit your time to it.
No, absolutely. And we'll, again, of course, whether that's next week or whenever it is, each week we have that new fresh COT data, which again, just like seasonality, it's to be used as a tool. So if we see some activity, kind of moving of the cargo ship, if you will, by hedge funds and smart money, and we know we're lining up with seasonality, we start to see some cracks or maybe some continuation, whatever that may be in terms of price, we can build positions off of that using that data and those tools. So yeah, I think that's a cool idea.
Yeah. Okay. We'll have to get that on the calendar here in the next week or so. Just give me 100 more yeses in the chat, and we'll officially put it on the calendar to do a full session there with an entire trade plan, all the data, and then put the trade on live. And also, if you guys don't mind, give Silas a shout out. We kind of called him last minute, said, hey, could you run through this for us? We just want to give some people a little more in-depth view, kind of a top-down looking at all the data. We were really excited the first time we saw those tools and kind of what Silas brings to the table. And there's a lot more that we haven't, got to show you yet. And so we're planning on having him back on. Definitely a couple more times we could do that trade. We could show some of the other tools. There's a lot more under the hood. So Silas, thanks so much again, especially last minute for jumping on and sharing it. If you guys hang tight, we're also going to talk about the income machine one more time because I know a whole bunch of people said they missed it yesterday. So we'll transition to that here in a second. But Silas, any final thoughts? Any notes to take away?
We're just watching price. Just watching price, not trying to chase things. And if there's opportunity out there anywhere you look, you just have to be smart about it and be patient and to get rewarded. But I want to say thanks to Nate and Graham and the team. Appreciate you guys having me on. It was a pleasure, and hope everybody else enjoyed it, and look forward to coming back on soon. Yeah,
absolutely. Well, thanks again, Silas. And so, guys, next I want to just transition here to the income machine real quick, because I know I talked about it yesterday, and I'm going to do that $50,000 worth of live trades on Monday. And I got quite a few emails who said like, hey, I saw something about the 50K or wasn't sure what you were actually talking about. What I was talking about was that core tool, the income machine, and actually finding those opportunities live on Monday in a session dedicated to the income machine and deploying $50,000. Because if you guys have been listening to what I've been saying, it actually mirrors very well with what Silas says. We're in a bull market. There's lots of opportunity. We are getting into a slower seasonal time, traditional time, and there are some signs for caution out there. And so this idea of having some defensive trades where you can get in, still be net bullish in your approach, but have upside potential and still have a whole bunch of trades with cushion to the downside that can still win. For me, is kind of the best balance to take on the world of trading that we're in right now. And that Palantir example is kind of an incredible example, because we are now like 25% clear there in the money. So unbelievable how much potential we have on some of these trades.
Yeah, Nate, I don't know if you saw the message from Rick yesterday. I'm not sure if Rick is here.
Oh yeah, here, I'll post it. I posted my Telegram too, but I'll post it for the chat for anyone who didn't see it. He's taken more trades than I have.
Yeah, following along religiously, but look at that. I mean, winners and losers. I think you're going to post here in the chat, but he's net ahead $23,804. with the income machine. And what I really love about it, Nate, especially right now when I'm a little bit risk off personally, what I really love is that buffer room you get. So even if stocks keep grinding higher or sideways or even slightly down, you're still able to get those payouts, get those opportunities regardless, and on really good stocks too. It's not like you're swinging the bat on any old random stock out here. And these are really good, strong, stable stocks where the options are paying. So average return of 18%. That's winners and losers. That's awesome.
Yeah, love to see it. So if you guys aren't using the income machine, I mean, I can't recommend anything higher than that, especially in the current markets and especially with our masterclass coming up. So we'll play that presentation right here. It's unlike anything else because you can try it for free. So it's really kind of a no-brainer to check it out, and you can even get into the class on Monday for free as long as you're an official part of the income machine. At least try it out. So we'll do that right now. And
no point not to try it out for free, guys.
Yeah, I mean, I'm sure most of the people in here have already taken that step, and I'll see them on Monday. But anyone who's not, please take your window of time here to take advantage of that, and I will look forward to seeing you on Monday.